All right, y'all. Welcome back. Another week, Sunday service. Once again, we're in the building with the 9 to 5 investors. It's Mr. Smart Money, my co-host, Mr. Black Pharaoh. The Queen's in the background. We got Tashana. As she would like to be called now, the surgeon. And Sean. What you going, scalper Sean, or you just Sean?
Say that.
Sean the Scalper.
Sean the scalper. And we got in the chat, we got the Queen Shonda and Willie. I don't know what their investor names is yet. We're gonna figure that out next week. But 9 to 5 was we in here. Let's go ahead and throw out our disclaimer. We are not financial advisors or fiduciaries. We are only 9 to 5 investors. Any information presented on this channel is for entertainment and educational purposes only. Investing in stock comes with inherent risk. It's up to you to determine how much of that risk you can tolerate. You must do your own due diligence. All of this is advice and our opinions. Let's go.
Let go.
So, this week, anybody seen anything interesting in the market?
Any new developments? I'll start with one, STEMI.
The big elephant in the room.
Get the elephant out of the room. STEMI has touchdown for most. He on the way.
Yes, sir. What them plans looking like for that stemming? We blowing it or we loading up on something? All right, what we doing?
Spring break is next week. We know, well, this week coming up, a lot of people gonna get an influx of cash. A lot of people gonna be out and about, spending that money. Some of us gonna be investing some of that money. That's STEMI. We got STEMI. We got 52-week highs. We got some 52-week highs this week.
We'll hit some highs this week.
We got eyes hit 52-week high this week. That's Second Sight Medical. We got Viacom. You still holding Viacom?
Hell no, man. I'm so goddamn mad, boy. I had a spread on them. It was from 53 to 59. The bitch is at 95 now. I should have bought an option.
God damn.
Should have bought the option. Bro, man, guess what? I sold my shit. I sold mine too. I just sold mine like a week ago. Playing around with the stop loss.
What? You got stopped out?
Oh, yeah, I had it too tight. I got stopped out.
Damn. How long had you been holding it before that?
Almost. That was one of my. Viacom was one of my first stocks. I think I got Viacom for free. That was one of my free stocks when I opened up the my portfolio, my brokerage. Yep.
Yeah.
My first stock, and then I had to add it to it. But that was one of my best performing stocks.
Add that to my list of regrets. That ain't Wayfair.
Yeah, man. And we also had Zeus. Olympic Steel hit 52-week highs. Funko, FNKO, Eagle. Oh, just to name a few of the 52-week highs this week. We had new lows this week. We had Lots, SNDE, Sundance Energy, WPG, Washington Prime, ACAD, Acadia Pharmaceuticals. All had new 52-week lows this week. We also had we actually had a rebound in the market this week. I see the VIX was down. The VIX is down to what, 21? I think about 21.
I see. It's funny you say it was a rebound because I was considering that little spark to be what they call a dead cat bounce. I posted in the Discord what the dead cat bounce was, but I felt like that's what was happening last week. A couple of the companies was just having 1 or 2 green days, then go right back to the downside, come back maybe half or whatever they went up the day before. I call it a dead cat bounce trap. I feel like the true recovery gonna come within the next 2 weeks. Like you said, with the stimulus news, you got a couple of places reopening, taking away the mask mandate, spring break, travel gonna be up. So that's gonna start to stimulate the economy. We should see a reflection in the market, even though we know that they don't go hand in hand.
So actually, aside from the tech, the market is it's been doing pretty well. The oil sector, we had big moves in the oil sector. We had big moves in the travel sector. Did pretty good this week. The reopening stocks. We're seeing a conversion in the country right now, where everything's starting to open back up. We're getting more people getting vaccinated. I was telling Darius earlier, I was listening to Mark Cuban last night, and he expects to have full capacity in his arenas by April or May this year. So we don't want to miss the train.
Right.
We're seeing a lot of these companies take off. The airlines, TSA, just posted their highest screenings for flights in a few months. So we're seeing the air travel pick back up. We don't want to miss the train on the reopening stocks, which we probably already kind of missed it, but it's still time to get in some of these companies.
Yeah, it ain't full blown open yet, so you can still get in.
Right.
Y'all heard about AMC?
Mm-hmm.
Speaking of reopening,
AMC reopened their theaters in New York City. Did they already reopen them? They back now? Are they on the way?
I don't know if they're on the way all the way. What I read was, remember a few weeks ago, we talked about what they would have to do to stay in business. And we talked about they got to compete with the HBO Max and the Netflix and Hulu. So apparently they're supposed to be partnering with Warner Brothers and coming out with their own streaming services. They got to step into that arena.
That's big. That's big. AMC was left for dead.
Right.
Now, compared with this meme stock Reddit craze, AMC may be coming back from the ashes.
Right. They got to reinvent themselves.
Yep.
You said thing about streaming earlier.
What's going on, everybody?
What up, Waldo?
What's going on? Cooling. A little late to the party. What we got going on?
You're right on time. We're just talking about anything we've seen interesting in the market this week before we get started.
Oh, okay. Yeah, I ain't see nothing too interesting. I kind of been chilling, man. I ain't got no money to throw in there right now, so I just kind of been chilling, letting my portfolio kind of get back the way it needs to be.
Yes, sir.
Yeah, but what I had just said, remember we had talked about AMC and how they have to they're gonna have to start streaming and they want to keep up with everybody else.
Yeah.
Yeah. So yesterday I read something where they're supposed to partner with Warner Brothers and start their own streaming company.
Oh, okay. I seen they had I don't know if it was Costco or Sam's, but you could buy movie tickets from the store at one. I don't know if it was Costco or Sam's or somewhere. So you can get like a 4-pack of movies, like movie tickets for like $12.
Oh, that's dope.
$11.99.
Oh, that's dope.
Yeah, for AMC. So you get the movie tickets from different stores. So I don't remember which store it was. I think it was like Sam's or Costco, one of them bulk stores.
So now you can, when you're doing your morning grocery shopping, you can pick up the movie tickets for the night at the grocery store. That's dope.
Yeah.
Yeah, I like that idea.
So AMC trying to make some move. Is
Trying to
they,
get off.
they just got a little dirt on their name because they were tied to little GameStop, but they really trying to make moves so their stock price can go up though. But I see what they trying to do. They better do something though.
Yeah.
GameStop. We saw GameStop creep back up this week too. Well, not creep. We saw GameStop run back up this week and then go back down.
Mm-hmm.
Anybody in GameStop?
Oh yeah, I ain't fucking with GameStop.
Not at all.
Nah, I ain't
I'll
fucking.
let them have their little fun.
Remember last week we was talking about the ETF Buzz.
Right.
Keep an eye on Buzz. Buzz is a new ETF, and it tracks the
Social media.
social media mentions of companies,
Cheap.
ones that's trending on social media.
Mhm.
Apparently, but actually, GameStop is not a part of their holdings.
That was your big thing.
Okay.
I looked
What
at GameStop.
y'all heard about subs? I gotta look into it, but have y'all heard about subs?
So what you mean?
It's an ETF.
Nah.
So it's like subs. I gotta look into it. I heard about it, but I ain't actually checked it out yet. But it's supposed to be everything that got like subscriptions. So like if it got a subscription service, it's supposed to be in like subs. So like Netflix, you know what I'm saying? Like
Peloton.
yeah, anything with like subscription services, supposed to be in like subs. So it got like all kind of different companies in there. So it's a new ETF too. So it came out recently. So I gotta check to see like they got options and all that shit on there yet.
Okay.
Yeah.
I like that.
Yeah, I gotta look into that one.
Subscriptions based.
I know. So Buzz top 10 holdings is Twitter, DraftKings, Ford Motor, Facebook, Amazon, Apple, Advanced Micro Devices, American Airlines, Netflix, and Tesla.
Right, Buzz. It tracks companies that's most mentioned on social media platforms, but the companies have to have a threshold on the market cap value. GameStop companies like GameStop and AMC don't meet those market cap thresholds, so they're not included within those holdings.
And they only $25. They're only trading at $25 right now.
Right. That may be a good good ETF in the future.
Mm-hmm.
Knowing how people trade now, people primarily, more people are trading based off social media than doing actual research.
Mm-hmm.
That's the thing about the retail trader. A lot of people not gonna look at the 10Ks and stuff like that. It's a lot of new investors. They're typically gonna flow their money to the companies that they hear the most about. We all been there. Before we learned how to do the fundamental research, the first companies we was buying was the ones that we were most familiar with.
Mm-hmm.
So I kind of like Buzz.
Waldo, what's the ticker symbol for the one you mentioned?
Subs.
SUBZ.
Yes, it's a Z. SUBZ.
Okay, let me see what they got.
They don't have any data. No data on them. They do got options though.
Some news I got on AMD was they made some changes to their chips. Certain chips that they was using for the games, they gonna kind of put them on the back burner, and they focusing on making chips for the miners for crypto. They doing that follow kind of behind Nvidia, I guess, to keep up. So I'm kind of concerned with how that's gonna impact the overall business, seeing as in the part of the business that they was focusing on for gamers, they kind of putting it on the back burner. And I don't know what impacts that's gonna have on them overall. But moving into the crypto, I kind of see that being a strong push if they can get it right. Because crypto gonna come in strong. I don't know how to weigh out.
Yeah, I see that as a positive for AMD. I'm holding AMD, by the way. I see that as a positive for AMD because it shows that they're expanding, and that's something that they're going to have to do if they plan on eventually competing with the Nvidias of the world. You know, AMD is primarily their focus is primarily gaming.
Right.
Nvidia, however, not only do they offer gaming chips, they also offer chips and technology for other industries. Like we know about the smart cars, the EV cars. They have partnership with automakers, you know, to implement their tech. That's a space that AMD presently doesn't occupy. So now AMD's thinking about, okay, we know we got the gaming industry on lock. Now we have to branch off and venture into other industries to get a foothold in those industries so that we can start to compete with the Nvidias. Because right now, AMD the underdog. I like AMD.
Yeah, Nvidia the big dog over there.
Yeah, but right now they can't compete with Nvidia because Nvidia has so much real estate in the overall market.
Yeah,
So
I think AMD really competing with like Intel. I think them two battling for like the leftover market shares. You know what I'm saying?
they
And
battle.
I think, yeah, and I think I really feel like they whooping Intel right now. So AMD in a good spot. They're in a good spot, man. I like AMD too.
I'm betting on the underdog in that spot right there. I like AMD.
Intel are wrong on the ladder. If AMD can get this deal with Tesla for these damn cars and they chips to be in them cars, it's over with for Nvidia too.
That would increase their foothold in the auto industry. Now they become a player. You know, like with the crypto, the motors, if they getting into they making chips for mining crypto and crypto take off, they already have a foothold in that industry.
Mm-hmm.
So I like them. They the underdog, but they feisty.
Yeah, they're making some nice moves, some bold moves.
Yeah.
All right, anything else anybody caught this week?
Well, real quick, I found the top 10 holdings for subs.
Okay, who they got?
They got Tencent, Netflix, JStream, Spotify, Roku, Brightcove, IQIYI, Walt Disney, Africa TV, and Kawashu Technology. Might be a Asian company. The way it's spelled.
What's in there? Tencent, Roku, Walt Disney. I see some good ones in there. Walt Disney just hit a 52-week high.
Some of the other ones they had that we know, iHeartMedia, Sirius XM, Viacom, AMC, Trade Desk, Lionsgate, Comcast, AT&T. They got Alphabet A, Amazon.
Verizon.
Yeah, so those are some of the other ones we might know. They got smaller percentages in the ETL.
Right. So subscription-based companies.
And they're currently trading at $14.46.
Yeah, I seen it's under $15. I seen that.
Yeah. Might be a good growth ETF.
Yep. Roku, one of my targets. They hold Roku. I can get exposure through them. We also the bond yield. The bond yield somewhat relaxed this week. We got to pay attention to it because it's at levels that start to impact certain sectors. When that bond yield increases, it greatly impacts the tech sector.
What's a bond yield, Jermaine?
The bond yield is the rate of inflation for the US dollar, basically, more or less, in so many words. That tracks the rate of inflation of the US dollar. Bond yields go up, inflation goes up. It affects these companies. I mean, these industries that's been previously overvalued, like the tech. That's why we're seeing big corrections in the tech market, because of the effects of the rise in bond yields. Overall in the market, the VIX actually went down. It was around 24 at the beginning of the week. Between 24 and 28, it's now down to 20. So we know the VIX is the volatility index. The VIX works in inverse of the market. We want the market to go up, but we want the VIX to go down. Because when the VIX go down, that means the market going up. So it works on inverse. So we also want to monitor the VIX. We like to monitor the VIX chart to see the overall sentiment of the market.
All right. So moving forward, we'll go ahead and get started with the discussion for this week.
Okay,
You know, you had to give people a little bit of time to adjust that they lost the hour.
Yeah,
You talk about where's the rest of the family? Niggas sleep.
Yeah, y'all sleeping in today.
No, you lost the hour last night. So even though it's 10 o'clock, it's technically 9:30. So some people probably just getting in the groove.
Man, my engine just wake up and go. I don't know nothing about all that. We just crank up and go.
I go with the sun.
Yeah, that thing got there. We going.
Well, we go with the eye mask around here. So when they come off, that's what we get.
We got to be in tune with the universe, Ned. We rise with the sun. We rise with the sun.
All right, let's get started with the lesson.
You got to get them chakras right.
Oh, wait, before we get started, we did have a good time at the bowling alley. We're going to do it again.
Oh, yeah.
People can come.
Yeah, that was nice.
The Queens did win against the men.
Let's not lie now. Let's not
lie.
Y'all didn't.
Don't
I
do
have
that.
the screenshots. I put
No,
it in the
y'all
Discord.
didn't. We were supposed to take one score away. See,
Y'all
you
really did.
over there in the conversation. Y'all had 4, we had 3, so we said we were gonna take one of y'all.
Right,
bowlers
y'all
away.
and then we said the top 3 scores was the Queens. One, you, and then me and T.
No. Put y'all 3 together plus us 3.
My score wasn't accurate because somebody bowled for me the last 3 frames.
No, the last.
So where you were?
2. The last 2 frames.
Yeah, my score wasn't accurate. I could have bowled 2 strikes.
Could have.
You was already the top of the. Was it Ladarius or Jermaine that was the top?
He was at the top. I was right behind him. We was battling for the lead, the 2 guys.
Yeah.
So what y'all talking about?
The Queens won.
No, y'all didn't.
How y'all won and me and him was battling for the lead.
But
Okay, all this mean is we need a redo.
Thank you.
Wow. Y'all sound like Trump.
So next time
I'm just saying we just gonna do a redo.
Recount. Y'all sound like Trump, a legitimate loss, and now y'all need a recount.
But y'all tell the truth.
They sound like Trump.
Yeah, they sound like Trump over
Stop
there.
the count. I'll tell the truth. Who was throwing them strikes now?
Stop the count.
Everybody, that last game,
Who was throwing them strikes now?
everybody.
My scorecard had more X's on it than the Million Man March.
All right, so we're gonna do it again, but this next time we're gonna give more of a notice so more people can come.
Yeah, don't worry, y'all. I'm gonna have I'm gonna bring guy number 4 next time. Thanks, Sean.
You bringing who?
I'll bring guy number 4 next time.
Okay.
No.
Y'all better get used to it.
Next
No.
conversation.
I'll call you later.
This week we're gonna kind of skip over Godfrey. You know, he hanging out But I got that stimmy.
Man, he got that stimmy. He got his tax return and he got that stimmy. He on vacation with the fam this week. He'll be back next week. He called me. He said that he don't trip. He'll be back next week, and he said he want to invest. He still got his stimulus in the money. He want to invest some of it in the market. So that's how we coming next week.
And he said, if y'all got anything to say about it, y'all better not be on vacay when y'all stimmy hit. Be glued down, cause he taking off like everybody else.
Yep. He said he gonna be he's still in full effect.
But for this week's lesson, I thought you were finna say some slick shit.
I wasn't.
For this week's lesson, we're gonna be discussing
market research. You know, at 9 to 5 investors, even though Godfrey on vacation, we always want to leave you with something. You know. So today we're gonna go over a little market research. As a new investor, in our eagerness to get into the market, you know, at first, like I said, we tend to look at companies that we most familiar with, the names that we hear, the brands that we buy. But how do we know if those are great? How do we know if those are great companies to invest in? How do we know if those are great companies to hold long term? Market research kind of helps you with that. So today we're going to go into a little bit of market research and how do you figure out, is this a good investment or not?
Hold on real quick before you get going. Is it in the screens? You're going to need me to pull up the show?
Nah, no screens necessary. Right. First, we want to get into the why do we do market research. Well, basically, like I just said, you know, you in it for the long term. You looking for companies that you're going to invest your money in long term, you know, to create revenue and generational wealth. You want to be in the companies that's best suited to do that for you. So how do we know? Are these companies strong companies? And we want to gauge the level of strength of the companies. So this is a reason why we do market research. How do we research a company? Well, we have various resources available to us through the use of internet. Resources like Google could be your first avenue. I tend to use Yahoo Finance, Zacks Reports, CNBC, YouTube. We have various resources at our disposal, you know, that can give us any market news about the company, you know, any possible catalyst for these companies. And a catalyst is basically any news or any input about the company that could increase the value of the company, whether it be the stock price or the overall value of the company. Or it could decrease it. A catalyst could also be negative. It could also be news that could drive the market, the share price of the company down. So we look through resources like Google, Yahoo Finance, CNBC, various resources to get any news about the company, whether it be catalysts, earnings reports, company stock splits, anything that's developing about the product of the company, the service that the company provides. We get that various news through these resources. Then we want to talk about the 10Ks and the 10Qs. These are reports that companies provide on either a quarterly basis or an annual basis. The 10K report, it's an annual report. It gives the company's annual financial report. The 10Q is the company's quarterly report. They come out every quarter, roughly every 3 months, 4 quarters in 1 year. I think right now we're in the second quarter.
No, it's still in the first.
Still in the first quarter?
Yeah, to the end of March.
Okay. These companies have a legal obligation to present these reports on time and to be truthful as possible in these reports. These reports contain information about the company, what the company does, how it performed, either quarter over quarter or year over year. This research is essential to every investment. Typically, what we want to do before we even invest in a company, we want to do this research first. We want to do our research first. That's due diligence. Please, I can't stress this enough. Do your due diligence before you start to invest in these companies. What to look for inside of these reports? Typically, we're looking for a few things inside of these reports that we want to take note of. One is the working capital. How much working capital does this company have? The working capital can be calculated as a total of the company total company assets minus total company liabilities. So this is something that's provided in the 10Q report or the 10K report. The total company's assets minus the total company's liabilities. That will give you the company's working capital. This number should always be positive. We don't want to invest in companies that have negative working capital, because that means at some point they're going to have to inquire, they're going to have to take on some debt to keep operating.
So will working capital be considered free cash flow?
No, working capital and free cash flow, those are they're different. Working capital is basically it's basically the money that we have to work with. The free cash flow, that's probably money, that's like side money, the money we have stashed to the side.
Right.
You know what I mean? That's the rainy day fund or whatever.
Okay.
The number two thing we should be looking for is earnings per share, also known as EPS. The EPS is net income divided by all outstanding shares. Now, you usually won't have to do the math. They already have the number there for you. When you open the reports, they already have the EPS number. It'll be right there. The working capital, they'll have the total company assets. Then you'll find the total company liability. You just subtract the liability from the asset. That give you the working cap. Earnings per share, that number they already present the number for you. But this is how they get the number. Net income divided by all outstanding shares of the company. EPS is the amount you earn for each share that you hold. So whatever that EPS number is, that's the amount that you're earning for every share that you hold of that company. If you have 100 shares of that company, each share of that company, the EPS, that's what it's earning. Number three.
Hold on. Can you say that the EPS is the net income divided by what?
By the total outstanding shares of the company.
Okay, thanks.
Okay, we good?
Yeah, I got it.
All right.
Okay, third is the PE ratio. The PE ratio is represented as the price per share divided by the earnings per share, the EPS, what we just went over. Typically, this number will be provided for you too, but this is how they find the number. It's the price per share divided by the earnings per share. So you would take the current price of the share, what it is at that moment, you would divide that by the EPS, and that will give you the PE ratio. The PE ratio is basically the premium you pay for the current company's earnings. So that's what you paying for the earnings that you get with this company. Number 4 is the debt to equity ratio. The debt to equity ratio is represented by the total debt divided by the total equity. These numbers will also be provided on the reports, the total debt and the total equity. That you can find those easily in the financial report, and you just divide the total debt by the total equity. That'll give you the debt to equity ratio. This measures how much the company owes versus what the company owns.
So if you calculating a debt to equity ratio, would you want the ratio to be on the high end or the low end?
You would want it to be on the
low ratio.
Yeah.
You want it
to be on the low end. You want it to be low.
Okay.
Do you know a low number?
Yeah, like a good point, a reference for what's considered a low debt to equity ratio, like anything under 1, above 1, 1.5.
I think it's 1.5.
1.5 or below.
1.5 or below.
Okay.
Don't quote me on that, but I think it's 1.5. I gotta look into that. But I think it's 1.5. But I think it's relative to the industry and the sector as well. Keep that in mind as well. So when you do a comparative analysis, you want to kind of compare the two and compare, the sector.
Right.
Some sectors carry a higher debt to equity ratio typically.
So go ahead.
It's relative, but you want to kind of keep that 1.5 in mind.
I'll say a good practice for that would be to look over each sector, whatever sector you're looking at, and figure out what the average debt to equity ratio is for that sector, and then go all based off of that and see if they're above or below the average for that sector, if you don't have that concrete number in mind already.
Okay. Number 5, the price to book ratio. The price book ratio is price per share divided by the book value per share. Now that's something I really it's a little more to that to get into the book value and all that. So I won't even get into all that. But you want to keep these 5 things in mind when you're looking to researching the company. You want to make sure overall, you want to make sure that company is growing. You want to make sure this business is increasing and not decreasing. So this,
okay, you want to make sure it increase, not decreasing, you said?
Yeah, you want to see overall growth. You want to see overall growth and increase in these companies and in these factors.
So what all you done hit so far? We done hit the earnings per share, the PE ratio, the price to book ratio, the debt to equity ratio,
and the working capital.
and working capital. Okay.
So those 5 things to consider when you doing your research. And all those things right there can be found in either the company's 10K or 10Q reports.
Go do working capital one more time.
Working capital. That's the total company assets minus total company liabilities.
This video will be on YouTube too, right?
Oh, yeah.
Right.
Okay.
And I'm taking notes. I'm gonna drop them in a Discord when we're done.
Thank you.
I gotta go over some of the older videos as well to add to the channel. Not all of them gonna be good enough quality to put on the channel, so I'm gonna see which ones we'll be able to use and which ones we'll just have to revisit again at a later time if we need to go over that lesson again or upload that video for some people. You got working capital?
Yep.
All right. So any questions about anything we went over? Everybody already got a good understanding on it?
Now once we this is what we call fundamental research. This is fundamental research of a company. What we want to do, we want to get in the habit of doing this before we enter into an investment every time. Every time. The companies that we are invested in, we want to know these things. We want to take note of these things. We want to know when these companies have earnings reports coming up, because the earnings reports provide these numbers for the quarter. So when you hear on the news that says this company X beat earnings, every time before earnings comes out, there's an expectation of what they expect this company to do, how much they expect this company to grow. When the earnings report comes out and the company has exceeded those expectations, the company has beat earnings. This is a positive sign for companies. This is showing growth, that this company has grown above above expectations for the quarter. So that's what it means when it said they beat earnings. Earnings time, that's very important times for these companies. It's four earnings every year, every quarter. So we want to keep that in mind also.
But it's also very important to understand how your company moves before and after earnings. A lot of times what happens is a company could beat the earnings report, but then they can also take a dip after that time, which
Psychologically for us, it don't seem to make sense, but more often than not, that's what happened.
Yep, but that's fundamental research. I mean, there's a few more things that you could look at. Those just the main things. But depending on how deep you want to dive into the research, you can look at the free cash flow. Maybe you can identify if that company has what we call a economic moat. They have an abundance of free cash flow just sitting to the side. What else I was going to say? Does that company offer dividends? The dividend yield? It's a few more things that you could, consider in your fundamental research, but the fundamental research is vital to investing. And that was fundamental research 101.
Yeah, that fundamental research is vital. I think you should look at that fundamental research before you even pull up a chart. You know what I'm saying? Because if you pull up that chart, it might look like a good entry, like the price done dropped. But if you go look at the fundamentals, it's already gonna tell you, no, this ain't no like a technical correction or nothing. This just a bad start, and it's probably finna go. If it's probably finna go to goddamn zero, if you know what I'm saying, if you paying attention to the fundamental, or it can tell you this is a good entry or this is a good company, and it lets you know they about to take off. You know what I'm saying? So I say do the fundamentals before you even look at the chart.
Gamestop, a prime example.
Yeah.
Gamestop, a prime example. The price on the stock is running up, but the fundamentals of the company is bad. GameStop been losing money for the past 5 years. So would GameStop be a company that you would consider holding for long term?
Hell no. GameStop, they're just about to file for bankruptcy.
Right.
Shit.
Right, but if you look at just the chart and the stock price, you may think GameStop a great company because it's sitting at $400 a share, $300 a share. You know, you may think that it's a great company until you look at the
Fundamentals. Mm-hmm. So, speaking of fundamentals, we had some homework that required a little bit of fundamental research. We're gonna go ahead and give Sean the example of their fundamental research on their company for the watch list. Willie, what up with you, G?
What's up, G? I'll go ahead.
Yo, step in.
Yeah, man, Willie did our homework
What
together.
was the homework?
Man, Willie did,
Now your sister trying to ride your way.
man, Willie did, we were group partners. So I'm just
She
gonna
can ride it, man. She can ride it, sis. Go on, hop on.
it was a group project. I'm just gonna let him speak.
Yeah. So the company I went with that Godfrey,
What was the homework from last week?
the company that we went with.
What'd you say, Jermaine?
What was the homework from last week? So we can let everybody know what we're doing.
Oh, our homework from last week. You were supposed to present your arguing case for a new company that we should suggest adding to God's watch list. And after you present your case, if anybody got any questions, we'll ask the questions or have any objections. You'll respond to those objections according to your research or whatever you know, and we'll go from there. If you're able to withstand the objections, welcome to the watch list. If not, get your research together and come back next time.
All right. What we got, Willie? Go ahead.
All right. So the company that we went with was Primerica. So Primerica, just for everybody, is a financial product company which provides financial products to middle income families, like everybody on this phone. So it specializes in life insurance.
Hold on real quick. Could you give us a ticker for Primerica?
PRI.
PRI, okay.
PRI.
All right, go ahead, G.
So basically they provide financial products for middle income families. So life insurance, financial planning, investment planning, also asset protection. They are basically a one-stop financial shop for your financial needs. So if you're looking to for investment planning, looking for financial planning, looking for insurance, life insurance, looking for to open an annuity, Primerica provides all of those financial services. They currently sit at $153.19. They're actually approaching their 52-week high, which is at 154.23. They have a PE ratio of 16.45. Now, within the past year, their dividend yield increased by 27.6%. And they currently pay out about 22.3% of its earnings out as dividends, with the annual $1.88 per share for dividends. That's what I got. Their dividend yield is at 1.24%. Their earnings per share, as of their last earnings report, which was February the 8th, is at $2.45 earnings per share. Now, within the past year, they've generated over $8.43 in terms of earnings per share. Now, how does that compare to their competitors? So I looked up two of their competitors.
We looked up. We
looked up two of their competitors. So you have MetLife and Prudential. When it comes to MetLife, they had a consensus price of 51.73 with a potential downside of 15.33%. Primerica has a consensus price target of 157.25 with a potential upside at 2.65%. So basically, Primerica has a stronger consensus rating and a higher possible upside in MetLife. Now, MetLife does have a gross revenue of over $69.6 billion. Primerica has $2.5 billion gross revenue. However, earnings per share, MetLife is at $6.11 for the past year, and Primerica is at $8.43 earnings per share. PE ratio for MetLife is 10.0. PE ratio for Primerica is 16.45.
I am Baptiste Loiseau, the cellar master of Rémi Martin. There's a whole.
All right. Now,
Yes.
Primerica versus Prudential. Now, Prudential wins in the category of EPS at $11.69 per share. Primerica is at $8.43 EPS. Now, Primerica, in terms of PE ratio, at 16.45. Prudential is at 8.3. Now, in terms of their earnings payout, again, Primerica is at 22.3% of its earnings paid out as dividends. Prudential is 39.3% of its earnings paid out as dividends. And they both companies increased within the past year. So Prudential wins in those categories, but where Primerica wins is in the risk and volatility category. Primerica has a beta of 1.45, which indicates the stock price is 44% more volatile than the S&P 500. But Prudential has a beta of 1.72, which the stock price is more volatile at a rate of 75% more than the S&P 500. So basically, Prudential is a more riskier, more volatile stock than Primerica. I would say that would be something that Godfrey should look into, because Godfrey is an investor. With a stock like this, there's no real worry about it becoming obsolete, because one thing that everybody wants to do is to gain their assets and protect their assets. And Primerica is in the business of doing so. So long as there is assets to gain, there are assets that are needed to be protected. And Primerica provides that. So yeah.
Yes, sir.
That was good. You went in depth, man.
Anybody got any questions or objections? Step up.
Willie went CNBC on y'all ass. And then went CNBC on y'all ass.
Man.
Ain't even going into that much detail.
That's some damn good research, Willie.
Yep.
Now, one other thing, there are a couple companies that cut their stuff. They cut their stake in Primerica, but it's mainly because those companies themselves are falling off. So Hancock Whitley and Crescent Asset Management, they cut their shares in Primerica, but the Bank of New York actually increased their shares in Primerica. So it kind of shows you basically, where they are in terms of growth and the volume of their stock.
Yes, sir. I had no objections.
Man, my boy Willie got a whole brick. He broke that bit down. He's selling nicks right now.
Yes, sir. He bust down the whole pack then.
That nigga, he's selling nicks, boy. He brought that bit all the way down.
All right. So my questions for Primerica would be, looking at the current price and the history of where the stock has went, how much further growth do you see in it? What would be the catalyst for the growth, and what would possibly slow down Primerica's growth?
Well, as of right now, this is something that I know off rip. It's a fact. Primerica actually increased. They're actually this year, they're increasing their overall gross revenue. That gross revenue report was actually from the year 2019, but actually as of this year, they're increasing their gross revenue to over $3 billion. So with that, Primerica, what it does, they utilize that revenue to be able to provide funding for their claims when it comes to life insurance. So Primerica has one of the quickest claim turnarounds. Whenever you file a death claim, it takes about 2 weeks or less, because the company is what is known as solvent. It's a very solvent company, which means they have the money to pay out claims. Now, what can slow down Primerica? Basically, honestly, it's if they lose any of their partners. See, Primerica is a one-stop shop. So you have AIG, they partner with Voya, they partner with other financial planning companies, financial product companies, and they have contracts with these companies. So what could possibly slow Primerica down is if Voya was to say, hey, we want to back out, or AIG would say, hey, we want to back out. If for any reason the company reaches insolvency, if they're not able to pay out death claims, that would be something that would probably slow them down. But looking at how the company is growing, knock on wood, I wouldn't say that's something that would actually happen. Because actually those companies who partner with Primerica, they've seen growth in their personal growth as well. Voya, when they partnered with Primerica, they became one of the most reputable financial investment companies. So is AIG. So actually their partnerships with Primerica actually benefited them as well.
So is Primerica like an asset management company?
Yeah, it's a financial planning, investment planning, and also asset protection.
Okay.
To your knowledge, is Primerica inside of any ETFs?
I don't know. I didn't look up that I don't know.
All right, so we'll have to do it. So if anybody was interested, you have to do your own research on that. But overall, that was a damn good job, Willie.
Appreciate
I got one more question. Is Primerica are they the leader in their industry? Did you say that?
They're not the leader because they're still relatively new. So Primerica really, Primerica at first was partnered with Citibank at first, when they first came on the scene. Citibank around 2008 with that whole real estate market crash. Citibank was one of the banks that kind of fell off. So Primerica kind of separated themselves from Citibank. So Primerica really has been independent on their own 2 feet for roughly 13 years now. But the growth that they've experienced during that 13-year span has been unseen. However, you do have the other big dogs like MetLife, Prudential, you know what I'm saying, New York Life, those companies who've been independent for years. But Primerica has greater upside than those companies. So what you will see is that a lot of those companies do generate more gross revenue than Primerica, but Primerica actually has more of an upside in those companies because they're relatively new and they're kind of surging, as to where everybody else is kind of plateauing.
Okay. Now there are actually 108 ETFs that's currently holding Primerica.
Any of them that we like or know?
Let's see. I thought it was iShares. I think we talked to VXF, the Vanguard Extended Market ETF.
Ooh.
They holding 7.5%. Schwab is holding. ProShares is holding.
Okay.
ProShares the small cap one. I mean, I'm sorry, mid cap. ProShares is holding Primerica. The Vanguard small cap ETF is holding them. They have 315,000 shares. Let's see anybody else.
That's some pretty good names right there.
And if you're looking to get at Primerica, right now, like Willie said, they're trading at 153.19. I have a support at about, we have a lot of things. I say about 140 would be a good buy-in. 138, 140 would be a good buy. If they drop below that, then look into the 120 range.
All right. Anybody else got any questions for Primerica, Brother Willie? All right, so we're gonna go ahead and add Primerica to the watch list. PRI. Anybody want to step up and follow that ad?
Yeah, I'll follow that. I'm gonna throw mine out there. You know, mine is a company that we all know and love.
What we got?
Well, our company that we got, me and Sean, being the scalp over here. It's a company that we all know and love. We all familiar with. The swoosh. That would be Nike.
Yeah, okay.
We know Nike. Ticker symbol NKE. Currently trading at a 140.45. Nike has a market cap of $221.4 billion. That will make it a large cap company. They do offer dividends. Dividend yield is $1.10. That's 0.8 cents per share. Nike is a business that develops and markets athletic footwear, apparel, equipment, and accessories, and services men, women, and children worldwide. Nike offers premium, well-designed, and high-quality products in line with the latest customer trends. Nike is the global leader in athletic footwear, apparel, equipment, and sports-related accessories, with operations in over 160 countries. The company's products include 6 key categories: running, Nike basketball, the Jordan brand, football training, and sportswear products. It also offers products for all ages and all athletic activities across various sports, including American football, baseball, cricket, lacrosse, skateboarding, tennis, volleyball, wrestling, walking, and outdoor activities. They pretty much cover the gamut. Anything sports related, Nike's your go-to. The company sells its products to footwear stores, sporting goods stores, athletic specialty stores, stores like Foot Locker, Champs, Foot Action. They also sell their products through digital platforms. They have their own platform, Nike Direct, platforms like the Sneakers app, Go app, eBay, specialty independent distributors. Nike, I currently hold Nike. Nike, reasons to buy Nike. They had robust quarterly results. My bad. Nike shares have outperformed the market. They have gained 53.1% in the past year compared with the overall industry's growth of 50.5%. Nike received an upthrust as the company posted better than expected second quarter fiscal 2021 results. Results gained from robust growth in digital business despite soft retail traffic. Like we all know that the brick and mortar retail traffic has been down across the board, but Nike has experienced increased traffic in the digital market, online sales. Nike they had a great holiday. They had great business over the holidays. You know, they had great sales over the Black Friday. Of course, we all know, you know, records. They had record sales during Black Friday week. Nike remains poised to gain from consumers' increasing preference for digital athletic wear, health, and wellness. Notably, revenues in Nike brand grew 9% and 8% on a reported basis and consistent dollar basis. On the back of the strength of the sportswear and the Jordan brand, driven by such impressive second quarter results, management anticipates sequential growth during the fiscal third quarter. So they already anticipating growth in the next quarter. Nike has been seeing consistent growth even through the pandemic. They've been outperforming the market. You know, they just beat the last quarterly results. And we know that Nike not going anywhere. If you're looking for a long-term hold, Nike's a good bet. Nike's the industry leader in their industry. And they consistent. So Nike, that's my company. You know, I can go into the EPS, I can go into all that, but we know Nike is Nike.
Okay. Any objections?
Oh, also, the reason why I went with Nike is because I was keeping in mind Godfrey's portfolio currently and keeping diversification in mind. He currently doesn't own any consumer staples. So I just want to throw Nike in there to kind of give him a little diversification in his portfolio. So that's why I added Nike.
Any objections? Anybody got any questions? All right. So for Nike, the same questions. Same questions apply. Looking at it for growth, how much further growth do you think Nike got from its current position? What would the catalyst be for Nike, and what would possibly stop Nike from growing?
I'm looking at currently, I'm looking at the market, what we talked about earlier, reopening, things going to start reopening. Right now, Nike has soft retail sales. They brick and mortar stores. A lot of them open, but they only like 80% capacity. So as we enter the reopening phase of the country, these stores are starting to see increased traffic. Also, over the course of the pandemic, Nike has turned their focus to growing their digital sales, their digital footprint. So we just saw they had record sales digitally during the Black Friday week. So this is something that could be ongoing even through the pandemic and after we reopen. And Nike has now increased their digital platform. So now you have the option of either going to the store or buying the shoes online. They direct the customer sales. They hitting all-time highs on that. So moving forward, I see Nike to continue to be the industry leader. through their various, not only through their various partnerships with the NBA and the NFL and other entities like that, but through their continued dominance in their industry. When the country reopens, people start going back out. They'll start, Nike stores will be back at 100% capacity. People going to keep buying J's. So I see expected growth. I see them exceeding their expectations, moving into the next quarter and beyond.
What could possibly be a headwind for Nike?
A headwind could be possibly another strain of the COVID, extended shutdown. Other than that, even in the shutdown, Nike still outperformed its competitors. So whether we go into a shutdown or not, it's not going to impact Nike significantly enough to where they should be, where it'd be a concern. So I really don't see any major headwinds other than the fact of the increase in bond yield. Could impact the overall sector. So
do you feel like political climate or social, I guess the conditions of the society, like, you know, they had the shit with Kaepernick, and players be taking a stand with protests and they don't want to play and all that. You think any of that could possibly pop up with the reopening or in the foreseeable future and cause any problems for Nike? Did that cause any problems for Nike when the whole Kaepernick situation played out?
now they actually increased their value because they had the Kaepernick line came out. It sold out within minutes. So they actually had an increase from that. And we know that if we look at Nike's business practice, they typically tend to lean into the controversy. They always find a way to market it and profit off of it. You know, whether it be LeBron James with the More Than an Athlete campaign, the Colin Kaepernick, Nike always seemed to be ahead of the curve when it comes to being on the right side of history.
Mm-hmm.
You know, they support various Black athletes that also support social change, which Nike also does. So I think they do a good job of that as far as the social aspect.
Okay. That's all the questions I got. Anybody else got anything? Take that as a no.
I got a question. As far as the pandemic and the brick and mortar stores and malls closing down and everything like that, how you think that will affect Nike's performance in the future? As far as stores closing down, like the actual physical brick and mortar stores and malls closing down, how you think that'll affect Nike in the future with sales and stuff like that?
You see that affecting the overall markets, and but Nike in particular, as well as several other companies, they have been, during the course of this pandemic, they have been positioning themselves to where they are not as dependent on the brick and mortar. Like we discussed previously, they increased their digital footprint, where they increased their digital sales of Nike online, and they direct to consumer traffic has also increased to record numbers. So we're seeing now that even if, say, a Foot Locker, brick and mortar outlets like Foot Locker and the Nike outlet or whatever, they're experiencing decreased traffic, but the traffic is now rolling over to buying the shoes and the products digitally on apps like sneaker apps and the Nike platform. So now Nike can now deliver. You don't even have to, where as before, Foot Action and Foot Locker, those were acting as middlemen. Nike has now started the process of cutting out the middleman and delivering the product straight to the customer.
X2. That's another reseller app for the shoes.
Right.
Yeah.
Right. All these companies, you know, Nike generate revenue from all of these digital sales of their product. The Go app, the StockX, eBay. If you buy a pair of Jordans on footlocker.com, you know that's a Nike product. If you buy a pair of SBs on the sneaker app, you know that's Nike's. That app is owned by Nike. So you still buying a product without even having to go to the brick and mortar.
Okay, they position well then. I'm all for it.
All right. What prices you got for us, God?
So we want to get in a Nike right now. They're just a little bit. Their high is 147.95. They're trading at 140. So I would say a good support for them probably around the 130 range. 130. If they fall below 130, then look at about 125.
Okay.
So we add them to the watch list. And
Nike, welcome to the watch list. Next company. You said you're gonna be the last one?
No, you was the last one. Or did mine with Willie. Primerica.
Oh, hell nah.
This is my company.
No, that is not your company. You ain't know none of that shit he said.
Yes, I did. I put it on the charts and I charted it. So go ahead with your company.
Yeah, she did the chart, dude. She did do the chart.
Yeah.
I couldn't do that, bitch.
She do the chart. She don't know none of that other stuff.
I know there's a good company, so therefore I went to the chart. Willie said,
what made them a good company?
A fundamental analysis.
What was part of the fundamental analysis that made them a good company?
The way they growing, how they keep it up with their computer, products and services they offer.
All very general statement. Somebody just done research.
Man, do your company.
All right,
man.
I'll go next. For my company, I had chose ArcelorMittal, MT. That's the ticker symbol. They're a steel company. The CEO, Lakshmi Mittal, he's been the CEO since 2006. They market cap 27.3 billion, annual sales 53.2 million. The institutional ownership right now 4.69%. They got a 2.09 beta. The equity ratio 0.26. Price to book ratio 0.67. And about the company, they're the world's leading steel and mining company. They got a presence in more than 60 countries. It operates a balanced portfolio of cost competitive steel plants across both developed and developing worlds. It is the leader in all the main sectors: automotive, household appliances, packaging, and construction, and is also the world's fourth largest producer of iron ore with 16 operating units. The year return on them, 219%, 5-year return, 96.93%. And they competitors, some of them we already know, US Steel, Steel Dynamics, STLD, Zeus. That was the steel company Jermaine mentioned earlier, having a 52-week high. What I feel like get them an advantage over some of their other competitors is their portfolio and steel products. They stepping up their footprint in the automotive industry. We know with EV, steel is going to be one of the important materials that's going to be required in constructing some of these vehicles. And also the steel products and household appliances with construction and infrastructure starting to come back. They could play an important role in that. They are already positioned a little better than United Steel. That was one of my favorites before X. I still like X, but for a pivot play, I'm looking at MT, and that also give us exposure to another industry. As far as how the company positioned financially, they don't carry a lot of debt. They actually reducing the debt that they did have. I don't got the exact number on how much they reduced it, but I did notice that the debt was going down. And that's about it. They right now sitting at 26.94. I feel like a good entry point for them. Put it up real quick. Look into it.
What, the chart?
Yeah.
All right, chart.
That's the price.
Sure. So they currently trading at 26.94. They have a
I said it right.
Okay, they have a high of 27.17, but they haven't held it there. So I would say my support level will be around 22 and change. Would be a good buy for them. If
But they gapped up, so if they come back down, the support before they gap.
20 and change, 20, around like 20.61.
But that's my still player that I like.
Okay. So what was did they have, what was their revenue growth?
The revenue growth over the past year. Let me get that for you.
Has it been increasing, decreasing?
It's been up and down. It had 1 year up, 1 year down, and then another year up. But for the long term, that's what I'm trying to get for like the 5 year. Over the past 5 years, it's been up. Revenue increasing.
Okay. So they got increasing revenue. Well, what's their ticker symbol? MT?
Yes, sir.
All right. And that's a steel, that's industrial. So we're adding a financial play with Primerica. We're adding a consumer staple with Nike, and we're adding an industrial with MT. So now we starting to get a little more diverse. His watch list starting to get a little more diverse. As it is right now, he's heavy into tech and EV. So we got to get him a little more. We got to get Godfrey a little more diverse in his a little more diversification in his portfolio. He does have ARKK and VTI. So we may want to add to those positions, or we'll see next week My boy gonna have that stimulus check. The money gonna be burning a hole in his pocket. He say he coming in hot next week, so we gotta be ready. We gonna look at these plays. We're gonna look at the charts. We're gonna set some limit buys, find some entry points, maybe set some limit buys. We'll see. But yeah, that'll be next week. And that was all for the companies, right?
Waldo got one.
Oh, Waldo, my boy Waldo.
Oh, and that ain't went.
I ain't even gonna cap, but I ain't do no company. I look like the list. Apple was on the list.
Yeah, Apple on there.
Oh shit, let me look at Apple real quick. Hold on.
Nat, you got somebody for us?
Hell no, you know, I don't never do the homework. I don't know where I be during the homework portion.
I might have a company.
Oh, now you got a company.
I was thinking about it now.
My second company is what I mean.
Oh, okay. Who is it?
CSX.
My company. All right, go ahead. CSX is the company she likes to talk about now.
But we know CSX, when they engage in the provision of rail-based freight transportation, that's a railroad company. Its services include rail service, the transport of intermodal containers and trailers. Rail to truck transfers and bulk commodity operations. All right, they've been around since 1827. So they've been around for a while. If you think about railroad companies, who else do y'all know besides CSX?
No competitors.
Nobody.
No competitors. So what that mean? What they is?
A monopoly.
Exactly. So.
Well, you gave us somebody with no competitors. Okay.
The EPS is 3.65. Price to book 5.47. The debt to equity ratio is 2.04. And the PE ratio is 25.76. Currently, let's see. They're trading at $93.85. I know you done tried them already. Just tell me what you got.
I gotta pull mine up.
Okay.
I can't minimize mine on recording.
All right. So let me see what we gotta do.
Shonda, you still with us?
Yeah, I'm here.
Okay.
I say around.
Yeah, I'm taking all this in.
All right, so we ain't losing y'all.
No. Actually, I'm glad y'all broke down the research. So now I'm gonna do my due diligence.
There we go.
I say about a good buy-in point will be about around like $89. And if they break that, I guess.
Yeah.
Around like 75.
That's the low of the boat price.
Yes. If they get down to that $75, then yeah. You can load up on that.
But a short term drop would be around 88, 89.
Right.
I don't really got no argument for CSX. That was already one of my companies anyway.
Right. I like the fact they got no competition, monopoly.
And you think about railroads, they've been here for this long. They ain't reinvented nothing to take them out of play. I don't see it coming no time soon.
Yeah, unless Elon started to make some EV trains.
Uh-oh.
That might be a good idea. I might need to go sit down and have a sit down with him. Might need to call my boy on that. Let me tell you.
Even if they go EV, they still gonna rock with CSX. They're gonna have that conversation with them first. Let's test out some of y'all freight, put it on this EV track.
Yeah.
I want to know why. I wonder if I think it'd be hard for another company to come in and compete with CSX. So when you think about railroads, they own a lot of. They either have a government contract or they own a lot of real estate because to have their tracks around the entire country.
Yeah.
Because it's like, what would you have to do as a company to get railroads across the country?
You have
all I see when we get stopped in traffic, all I see is CSX.
Right, because if let's say we was a company, we wanted to invest in a new company, we wanted to build a new company, a railroad company. What would we have to do to get railroads? Like, you have to go to each city and get permits to even get a stop sign or build a sidewalk or anything. How are you gonna be able to do that? Like, that's probably why they don't have no competition, because that's a headache in itself.
There's too much to take on.
And you would have to, you would probably have to use their railroads.
Yeah, because if they, who own the tracks?
Right, who own the tracks?
How you gonna start off
your own tracks? You got to do that across the whole. Like the railroad is almost as old as the country.
Right.
Mm-hmm.
You know what I mean? We remember the period of time when they was going out west and they was building the railroads. That shit is a lot. So for somebody to have to do that all over again, ain't nobody all that.
Yeah.
Partnering with them and use their tracks.
And another reason I feel like the railroad is not going anywhere, even as technology moves on, we have to understand there's places in this country that can't get freight unless it's through the railroad. Like we on the coast, so we can get stuff docked in. But once it gets off, once it comes to the port, it has to get on a railroad to go to other parts of the country.
Yeah.
Everything can't be flown.
Or it can't be on an 18-wheeler.
Yeah. Another good thing about railroads and shit, you gotta think, what would be a season or condition that would halt them or cause them to slow down?
Nothing. They travel any weather.
Ain't no stopping the train.
They going, even when the pandemic, the country shut down, they still going. They provide industrial materials. They still going.
The only thing that you would have to consider with that is you already have to know this when you invest in a company like this. It's going to be slow money because it don't really have no catalyst that's going to make it spark and jump up $2 in a day or nothing like that. But it's going to definitely grow over time. Mm-hmm. And I believe CSX pay a dividend as well,
they
too.
Do. They got a dividend of $1 and change.
That'd be a nice additional dividend play along with Nike.
And sometimes that's what you want. You want some companies in your portfolio that's what we call slow growth.
Yeah.
Sometimes that provide that level of consistency for you.
All right. This is what I just found. When it comes to the tracks, CSX owns most of the tracks in the country. Amtrak also owns some tracks. So what CSX does is they pay Amtrak $1.5 million a year to use their tracks for the ones that they don't own.
Damn. Sold it up.
Now Amtrak also pays them.
Amtrak got them trams on them trains.
Right, that's the
express type shit.
When people travel.
Yeah.
Amtrak more like for passenger travel.
Right.
Right.
But they basically changing out money because Amtrak paid them $140 million.
Yeah, they just swapping out.
Right.
Yeah, that's a nice company to have.
Thank you.
CSX.
No, you should be thanking me.
For what? You ain't tell me about them.
Stop it.
We talked about CSX, but I'm saying
plenty of time.
But you
done seen my notebook and all.
I ain't seen your raggedy behind notebook.
Here you go.
Tell them you gotta present it, huh?
Right. You ain't tell me none of this information that I came up with.
All right.
It's who presented to the meeting, huh?
Right.
That's how I go around here.
Not raggedy notebook.
Not raggedy, yeah.
That's why I keep my notes in the safe.
Oh Lord.
Man, I have to follow suit.
That's classified information.
Yeah, right. What say?
Hey man, that's it for the meeting. We're gonna go ahead and wrap this up for this week. Thank y'all for attending 9 to 5 service. We'll see y'all next week. Peace out.